When we start our journey in the stock market as a beginner, our trading journey, and let's be honest, even our life feels confused. We take some trade, we see some charts, we initiate positions, we sometimes follow someone on X or Telegram to get some opinion of the stock. But to be honest, it's quite messy and it's quite random. We don't have any process and we really don't know what mistake we are doing at that point of time. We're simply trying to execute some trade with the hope that it will make some money. I know this because I was one of them. Hey everyone, my name is Gaurav and welcome back to my channel. So today in this video, I'm not going to share any new process or new strategy. Instead, I thought why not to compile a strong list of mistakes which every beginner does while starting in the market. And what would be the best way to fix those mistakes so that in long term you can achieve a super performance return. So with this, let's deep dive. Let's go to the first one, which is messed up entry point. Now look at this chart and let me know where would you define your entry on this chart. So before I answer what could be the possible entry points, one thing which you need to understand that entry point is not just about buying. It basically describes everything else which happens after that. So the moment you decide your entry point, your stop loss, based on the stop loss, your position size, based on the position size, your win rate as well as risk reward, everything else which will happen after that will be decided by this one single decision. Alright, so let me quickly explain you with the chart. So if you see the chart, there are two entry points. So one is simply when the stock is moving up and because of FOMO or whatever the reason, we entered here. It's a random entry point, right? Which is around 436. Now if you enter here, your stop loss will be quite loose or quite wide. If you see the second entry point, which is a perfect entry point I've called out, where the tight consolidation is happening and then the breakout happened, right? And this entry point is around 556, which will give us a stop loss of around 3 to 4%, maximum 3%. So what I wanted to highlight that because of this precise entry, how quickly your stop loss and gain and RR everything gets changed. So let's take assumption based on the previous chart. So let's say our overall portfolio is 10 lakhs and generally the risk per trade, I'll discuss about this in a minute, but generally risk per trade is generally 1% of our portfolio, which is 10k. Okay, now there are two entry points. Entry A, which is 436. Now because of your late entry, your stop loss was around 7%. Let's suppose you got a return of 24% in this trade. Now entry B, which was around 556. Now since your entry was perfectly timed, your stop loss was hardly 3% here. And in this case, let's assume that your return was hardly 15%. Now you see the comparison here. Okay, so with entry A, your stop loss was 7%, which was around 405. Now since your stop loss was 7%, your position size with this formula, I mean you can do your calculations and everything in later on, but in nutshell your position size in this case was around 1,42,000. Since I gained a profit of 24%, overall profit I gained around 35k, which is approximately 3.43 R. Okay, quite decent. Now look at the entry B. Entry B, your stop distance was 3%, which is around 539. Right, so in this case, if I keep the same risk of 10,000, which was an entry A also, my overall position size increases to 3,33,000. Now if you see the comparison and try to understand the difference here, in case 1, when you had a stop loss of 7%, maximum size you could go around 1,43,000, right, because of risk limit. But here with the same risk limit on your portfolio, you can go approximately 3,33,000. And that's the biggest change. The moment your position size increased, even with lower profit return, which was just hardly 15%, we will receive around 50k as a profit versus 35k in our case A. And because of that, our risk reward immediately changes to 5R. This is what I'm trying to explain you, that higher return doesn't mean better trade, right? Your entry points should be so impeccable so that your SL will be very tight. And because of that, you can size larger, you can have a larger position size. That will help you to get a higher R multiple, which means more money. It's very simple equation, very simple understanding. So the key point here is, as a beginner, you need to have a very defined entry point. You can't just enter anywhere based on the chart or price movement and somebody posted on X or Telegram and you randomly entered it. That is not right way to enter. So for me, if I take that chart example again, this will be the decent entry point, and I will discuss about why in mistake number 2, which is trading without a clear setup. This is the most irritating mistake which I see a lot of beginners doing it. They really don't have a defined setup for them. On daily basis, there are thousands of stock which moves, more than 4, 5, 6, 7, 10%. So which stock is basically meant for you? That is something you will be able to understand based on the setup which you define for yourself. So what are the key things which you need to have a clear setup? One is clean price structure, right? You should have some base, range, lower highs, contraction, some kind of a clean price action. Location, right? So this should be aligned to overall chart location, base 1, base 2, near support, breakout levels. You should have a defined entry trigger on your setup and clear invalidation logic. So if the setup fails, what will you do? Along with that, from the psychology point of view, it should be simple enough to make sense to you. It should be quite easy for you to understand, and it should be repeatable in almost every asset class and also a different market like India or US, right? I'll simply give an example. So if you see on the screen, this is how I define my setup. As I said, clean price structure. It has a prior uptrend and then consolidation, forming a tight base. My location is basically support near EMA, which is could be 51 EMA or 11 weekly EMA. I'd have a very defined entry point, the breakout of inside bar or a tight contraction or narrow range 4, narrow range 5 bar. The moment a stock goes below those narrow range, maybe around 3% to 2.5%, I simply exit it. And I've also discussed the setup in this video in detail. If you're a beginner and if you want to use the setup, by all means use it. And now since you have understood my setup, look at this chart again, which I have mentioned a few minutes back. So prior uptrend, a decent quiet base. Now here if you see there is a load sheet entry using inside bar, that's advanced entry. If you're a beginner, ignore this. Let the base get completed, and at the top of the base, I see a tight contraction on the right side of the base. As per my setup, which I've shown you, at the high of the base, I see the contraction at right side of the base. So that is what I'm seeing over here, these three candles, and I will simply enter when these candles breakout happen. Okay, so that is one entry point, and let the stock move, right? If you have missed the set entry, then let the stock move and let the stock pull back. Few candles which you see here, that could be our second entry point after the first breakout of the base. And anywhere when the breakout will happen, you can enter here. So maybe the breakout of these 3-4 tight range candle, this could be your entry point, and you would have captured decent amount of 20-30% return. So this is how you have to make your entry logical based on the setup which you define for yourself. Next one which I have is more indicators instead of clarities. As a beginner, I personally know, because I was the same, we are obsessed about indicators. In my initial days when I started, this chart which you see literally was my chart. It was too cluttered and there was no clarity. And I totally understand that, because in our initial days, we don't have understanding of price structure, price action, right? Hence, we start relying on a lot of indicators which will make decision for us. As we know, right, like every indicator is a lagging. But as of today, if you are new and if you don't understand anything else, you use simple one moving average to do everything else. If you look at this chart, the white one is 11 daily EMA and the yellow one is 51 daily EMA, right? So I can usually see this chart using its EMA, and I can say that, okay, so EMA is trending up, hence chart is trending up. I can also use my EMA to define my entry point. So if the chart pullbacks and formed a very tight consolidation to its EMA, I can time that. I can use that as an entry, because many times I have seen that stock comes and pullbacks to its key EMA and form a very tight consolidation, and that could be our entry point. I can also use as a trailing mechanism or exit criteria. So simple 11 or 21 EMA, I can use it to trail it or exit my position. I can see there is a big gap between these EMA, which means there could be a deeper pullback near future. So overall philosophy is very simple, that you put an indicator, no problem, but then still the chart should be readable. Indicator should only act as a supporting device, not a decision maker for you. And the third is, one indicator or probably two should be used for the multi-purpose. So as I mentioned, like moving average, I use it for almost everything, right? Along with my setup. The next one which I want to talk about is putting too much money in one trade. This alone can end a trading career even if everything else is right. So I understand that as a beginner, when you start and when you see couple of losing positions, you immediately wants to make that money back, and then you enter into PNL based trading, fear based trading, or revenge trading. As of today, as a beginner, if you have to take away one simple concept, that would be so never risk more than 1% of your overall portfolio in any trade. So for example, if your total capital, let's say, is 10 lakh, and as I said, the core rule is 1% risk per trade. So I will not risk more than 10,000 in that one position. Why 1% rule matters? So because it ensures survival. So basically 10 losses in a row will have approximately 10% drawdown, which can easily be recovered. Then it builds consistency, create conviction. So any small losses won't basically shake your confidence. You can still be in the market and you can execute fearlessly because you have not lost much in that particular trade. It works even if it is a low win rate. That is the best thing. And you can scale across the account size. If your account size is 1 lakh or 10 crore, you can still use the same 1% rule across the market. I will discuss more in detail. For now, just ingrain in your brain that you should not over leverage or over position size in one single trade. The simple rule which you can use is that if I'm initiating a position, I have to put a stop loss in a way that overall risk on this particular trade would not be more than 1% of my portfolio. Next one is tracking too many names. So let me start. Have you read this book, How I Made 2 Million in Stock Market by Nicholas Darvas? And what is your biggest learning from that? I mean, I know a lot of people will say Darvas box, money management and all those bit. But for me, the biggest learning was cutting the noise. So if you read this book, I think in his chapter 9 where Nicholas Darvas moved near to the Wall Street and then he started losing a lot of money because he got closer to the market. And I personally felt that this is the biggest problem currently in today's world, right? It has really become a lot of noisy and a lot of chaotic. But trust me, once you start advancing towards a mature or professional trader, the first important point which you wanted to fix is your about watch list. You need to have a very concentrated watch list. And I personally feel as a beginner, the biggest reason of tracking so many names that we don't want to miss any opportunity. We are so much full of FOMO, fear of missing out, that we want to be a part of every stock, we want to be a part of every movement. Those kind of thinking and psychology forces us to not to have a concentrated watch list. So the next question is quite obvious as a beginner, that how to have a concentrated watch list. First of all, identify what exactly you are looking for. So once you have entry or setup defined, we know that we wanted a stock which is trending up and we want to see the stock which is basically tightening on the right side of the base. So once that is clear, I basically create my watch list based on that. So these are the three most important factor which I look while creating my watch list. Use the same. I have already discussed this in this video. Don't hop for a lot of watch list, lot of frameworks to create a watch list. You will miss some name, but in long period of time, your equity curve will always go up once you have a concentrated watch list, hence concentrated tracking. With this, we'll go to the next one. Next one is not knowing when to sell or stop loss issue. So if you look at these charts, what would you do at this point? So you entered into the stock here, stock went up, couple of bars, it went up more than 30-40%. What is your rule? What will you do over here? Or what will you do in this particular chart or stock where you have made an entry, stock went up few days and then later on went down, stop loss hit, but you have not exited because A, you might not have a rule to put in a stop loss, and B, even if the stop loss been hit, you don't have enough a strong mindset to, execute that stop loss. And then later on the stock went something like this. As a beginner trader, we are too much focused about gain or profit. We don't think, or our brain doesn't think much. What will you do if the stock went up and pull backs and take away all your gain? Or a stock doesn't move and go down and hit your stop loss? Or stock is too extended, what will you do? Will you book some partial or will you still hold that stock? Because these are the small things which will separate you as a beginner from an advanced trader. So that is why having rule is very important. So I basically summarize my rule in this way. I've discussed this bit in detail in this video. You can definitely check this out. With this, let's go to the next one. So next one is trying to win every trade. Okay, look at these stat, right? So win rate is stat for some of the great trader like Mark Minervini, who has hardly 40 to 50% of win rate, which means he loses more than 50% of trade. Christian Kulamagi, who made millions in a very short period of times, hardly 30 to 40% of win rate. Dan Zanger, very well-known trader, hardly have 35 to 45% of win rate. So the best trader in the world win hardly 50% of the time. We as a beginner wants to win 100% of the time. Funny, isn't it? So from where this mentality comes in? This mentality comes in because we subconsciously think that more we win, more money we will make. That is true partially. And that is why it's very important for you to understand that your profitability doesn't come only from the win rate. There is a correlation between win rate and risk reward. I don't want to go deep into this. You need to understand that even if you have a low win rate, with a higher risk and reward, you can still make a super performance return in the market. And this is what mathematically has proven, and this is basically the known fact. Once you start focusing on lower risk, higher reward, even if with a low win rate, you can achieve an extraordinary result. And this is proven fact. Next one is fear, greed, basically your mindset and psychology side. Overall market operate on these two emotions, right? First one is fear. So let's say as a beginner, you have fixed your setup, you have fixed your entry point, you have a rules of exiting the trade. But when you trying to implement these rules, right? So for example, when you're trying to enter into a stock, you start doubting yourself, you start doubting your confidence, you basically go into fear zone, and basically this causes us a hesitation, hesitation to execute our rules. And similarly greed, right? When the stock goes up and it get extended, instead of booking a partial profit, you just simply wait, but then stock reverses and all the profit which you have made now it turned into a loss. So these both the factor fear or greed comes because of lack of rules and lack of understanding about your mindset and psychology. Now 2 minutes of my this monologue not going to help you. So this is something as a beginner you have to really put a very hard effort to improve on this part, because I did it. I really have to struggle to improve my mindset and psychology as a trader. I suggest you to read these two books. One is Mental Game of Trading by Jared Tendler, and the second one is, which has really helped me a lot, is Best Losers Win by Tom Hogarth. I'm pretty much confident that these two books will fix your most of the problem. Alright, so with this we have come to end of this video. The key difference between a professional trader and a beginner trader is not about intelligence or stock selection. It's simply being aware of those mistakes which you're doing currently and then start fixing those mistakes. If this video has helped you to understand those mistakes, hit that like and subscribe button, and I'll see you in the next one. Bye.